Stephen Graham. He's the lead partner at Graham Partners, which is a private equity company. Today, we're going to just talk about how, number one, when we're starting a business, how we can grow the business and what we're looking to do to get some differentiation in our business model. So ultimately, we can get somebody else. Really, the true customer is somebody that's willing to invest in your business to get it to scale, whether that be like the bank or somebody like Steve, who's working at a equity firm that's going to try to buy some equity out of the company. And what they do is they leverage, and we had AJ Tracy on before, what they do is they'll leverage their own capital and mix in their cash to get to buy into businesses like your guys have. So, Steve, man, welcome. You can tell me a little bit about what you've done in your history at Grand Partners over the years, and we can get started.
Yeah, no, I'm well happy to be involved, and it'd be interesting to learn a little bit about some of the businesses that your people are on, who are on this call. And I guess you're running a class, right, Dom, on sort of business strategy and growth and raising capital and so on and so forth. So Graham Partners is what is known as a private equity firm. And so we're basically managing capital. And in our case, we're managing capital for institutional investors. So those would be very large investors, such as a public pension fund. It could be a university endowment, a charitable foundation, an insurance company, or banking institutions. And so they allocate their investment capital to specialist entities such as ours, and then we deploy that capital in different strategies. So in my particular area, the strategy that we're investing in is advanced manufacturing and industrial technology, but there are firms like ours which specialize in, venture capital, sort of like technology plays. There are, people that do energy. There's people that do real estate. There are hedge funds that invest in the liquid markets, meaning stock and bond markets, and so on and so forth. That's not really our thing. We buy private companies, and actually through our funds, we primarily buy control of privately held companies which have been built up by entrepreneurs. And we will work with the existing management team of those companies to sort of grow the businesses and strengthen the organization and add more to the product line. And ultimately, we're going to sell the companies, because we're in the investment management business. So we're going to hold the investments for 3 years, 5 years, 7 years, could be 10 years, and really try to deliver to the next owner a bigger and better managed organization. So in our particular strategy, we're actually, buying businesses from someone who wants to sell all or substantially all their business for various reasons. Maybe it's somebody that built a business up and he's got 2 kids in the business and 3 kids who aren't in the business, and he's grown it to 100, 200, 300, or $400 million in sales. And, for estate planning purposes, he'd like to monetize. We step in, and, there's a whole structure. But, in the private equity space in general, there are many, many firms with many different strategies, investing in businesses of all different sizes, including very small businesses and, businesses that are much more substantial in size. We have thousands of employees across 15 or 20 companies at any time that we happen to control through Graham Partners. And then an investment team in the Philadelphia area that's in the 70s, investment and operational people, which work on new investments, sourcing new things, closing deals, and then working with the operating companies and their management teams.
How old, on average, are some of the businesses that you guys are looking into? Like, have they been around for like 20 years, 30 years to get to that kind of size? Or?
Well, it's a little bit of a mix, but there are some businesses we buy which have scaled very rapidly because somebody's come up with an innovative manufacturing technology, and it could be a 10-year-old business, and there could be 20 and 30 potentially. But we're really looking for, in our strategy, we're looking for businesses that are benefiting from a growth catalyst in the industry in which they're participating, like, for example, what we would call a conversion trend. meaning a product substitution trend, a raw materials conversion, some sort of a shift taking place in the industry. And so these tend to be pretty innovative companies, and they don't, they're not really 50-year-old businesses. They're businesses that might in certain cases be 10 or 15 or 20 years old, and somebody's built the business. For whatever reasons, they've decided that they want to exit in part or in whole, and we step in with capital for growth, as well as capital for the entrepreneur to monetize the franchise that he or she has built. And the sectors that we focus on would be things like the food sector, or things like the medical devices sector, or things like the industrial technology. In our particular strategy, most of the businesses that we acquire are actually making something. They're not in the service industry, but there are firms like ours, which are in the service industry, and they could be in retail, they could be in, a variety of different strategies. We stay fairly focused where we think we have an edge. And we're really managing money as fiduciaries for large university endowments, for pension funds and so on. And they have certain return expectations that they want to obtain. And that's why they outsource their investment management to firms like ours, which, presumably have some sort of an edge or something to bring to the table.
Absolutely. And then, for you guys, the key that we've been trying to drive with CGM Premium since September, when we started it over the last few months, is how can we create this differentiation in our business model that you guys have? So Octavia, you have the cosmetic line. You also you're starting your own agricultural farm down in Virginia. Doug and Nikia, you have your daycare. Chandra, you're doing real estate. Kima, you're in construction. So when we're looking at our business model, we're looking at, okay, we get exchanges. So we get customers to pay us for a good or pay us for a service, right? And that exchange is going to just be like proof of concept. People want it, consumers want it. But how do we get to the next iteration of the business where our business can begin to grow and it can kind of sustain itself, right? And so somebody like Steve, who's seen businesses from different sizes over the years, these kind of conversations, I really want you guys to really just kind of jump in and ask any question as the conversation unfolds. And normally what we do is I'll lead it. So today we'll be kind of going into a small conversation about what Steve is seeing when it comes to business growth. And then, guys, I don't want you to be gun shy. I want you guys to like rip any question, because you guys know I talk about Steve a lot on these sessions. So here he is in the flesh, right? So Steve, as young entrepreneurs, meaning the term of the business, some of these businesses are 8, 9, 10 years old. How important is like lending or like leverage in growing the business for a company? And how have you guys used it over time to grow grant partners? Like what's a good strategy for like using like bank loans or lending or capital in that sort?
Yeah, well, the capital structure questions are one thing, and I'll come to that, but most important, for us when we're looking at these businesses is there anything differentiated they're really doing? Do they have a sustainable competitive edge? Do they have a product development capability? You look at a really successful company like Apple, every time you turn around, they're sticking and moving, they're adding new benefits and features to their product line. The reason that they've become so large and so successful is, through the innovation. So even for very small businesses, like some of the entrepreneurs on this call might have, one of the things you got to, sort of ask yourself is, what am I doing to innovate, be creative, sort of and essentially create a need in the marketplace for the offering I have. And then what is it that I'm doing, with my business that gives me a sustainable competitive edge? Is that because I'm able to offer the product or the service at a more efficient cost, better, better services, and so on and so forth. And so when we're looking at businesses, these are some of the things that we're obviously focusing on, and we're looking for businesses that are benefiting from a shift in the industry in which they're competing, because there's a technology shift or raw materials change or some other special growth catalyst. And then we're looking for businesses that have a sustainable competitive advantage in terms of their know-how so that they can do what they do, delivering better products at lower prices. And they're constantly innovating with new product development programs and cost savings programs. So before you get to capital structure, this is a fairly pivotal. And then when we come in with the businesses, we do buy businesses from a lot of family owner operators, maybe 70% of the time. Now, these businesses are decent size. It's like 100, 200, 300, $400 million in revenue, but still a lot of those businesses don't have professional management, teams. It's great if we do, but this has a lot to do with the value proposition. We come in post-acquisition and we have an operations overlay that is really designed, to strengthen and enhance the organization that we've inherited so that when it comes time for us to exit, we're delivering a better, safer, bigger, stronger, more profitable, but a better asset to the next owner, because we're in the investment business and we're in the business to generate returns for our investors. Now, when it comes to capital structure questions and accessing debt and so on and so forth, the one thing, with debt is it's cheap rent money. That's all it is. It's low cost money. Anybody that's willing to essentially allocate us $1 and only ask to get paid, 3 or 4% per year. Well, I kind of like that. That's a lot better than bringing equity in, where somebody's sort of saying, well, I'll invest $1 and I need, I need 15% of your business. And by the way, every time, you go to, change the curtains, I want to have a discussion about it. So I actually, in some senses, like the debt, but you got to also understand, if something goes wrong, the debt gets paid back first, right? In the seniority and the capital structure. And there's pieces of paper there and pieces of paper matter, and meaning there's covenants and there's various different things that you're entering into with the lenders. But the lenders are in a tough spot. They're, if you have a deal where, you brought in a bunch of bank debt and you've got some investor equity and things go sideways a little bit, it's sort of like, hey, we all gave it the office, right? Lender, you made a bad deal. Equity investors, you made a bad deal. And you've got to sort of be prepared to negotiate and restructure. So, the point is that I don't know the sizes of the businesses that you're dealing with here, but there's a lot of things that they probably want to have in order and in place before they start tapping into the market with lenders. But on the flip, to the extent that they need capital for growth and they've got a good plan, the lenders aren't the worst place to go. And in fact, in many regards, they might be better than bringing in an equity partner, particularly in an entrepreneurial oriented smaller business, that's sort of scaling a little bit. Hope that answers the question somewhat.
Yeah, that was great, because what a lot of our clients, they get into is like, they're thinking, hey, I want to expand. I want to bring on an investor, right? So somebody might want to give them 200K, 300K, 400K, but they want to come in and grab like 30% or 40% of the company. But there's things that, like you mentioned, may not be in the best interest of the business, especially when looking at an investor portfolio. And you're like, hey, do you even have knowledge space in this space? Like, not only bringing capital, but what else are you going to bring to the table? So yeah, you answered the question, I thought, excellent, because a lot of people, they get in a tough spot where they're like, hey, somebody wants to invest in my company. I think Octavia had this question a couple of months ago, but that it's not just about the money. It's like, all right, what are they bringing to the table with the money? Do they have connections in the industry that you're working in? Do they have a high level of knowledge in that industry? Can they change the business operation? Whereas like if you go lending, the bank, you can get the same capital, low rent, and begin to reinvest in the things in the business that can grow it to the point where you can meet somebody with a little bit more knowledge base. So there's always two roads to take, but we want you guys to kind of understand that.
You can bring investment capital in. Of course, some of the most successful businesses that have evolved over the last 15 or 20 years have brought investment capital in, whether it's Google or
Mhm.
Amazon or eBay, any number of these have brought investment capital